You've been told the gross rent multiplier is dead, antiquated, a relic from an era when spreadsheets were novelties and cap rates hadn't yet colonized every investor's vocabulary. But here's the uncomfortable truth. While sophisticated algorithms and AI-powered valuation models dominate today's market, this simple little ratio refuses to die. And maybe that's because it was never supposed to replace your analysis, just started. So what are we unpacking today? We're diving into whether the GRM still deserves a seat at your investment table, why some investors swear by it while others mock it relentlessly, and how a metric born in simpler times might actually be your secret weapon in an overcomplicated world. Let's get one thing straight. The gross rent multiplier is brutally simple. You take the property price, divide it by annual gross rent, and boom, you've got a number that tells you how many years of rent it takes to pay off the purchase price. If a property costs $300,000 and generates $30,000 annually in gross rent, your GRM is 10. That's it. No adjustments for expenses, no cap rate calculations, no net operating income gymnastics. And that simplicity, that's precisely why the critics sharpen their knives. They'll tell you it ignores operating expenses, vacancy rates, property taxes, insurance, maintenance, all the messy realities that separate fantasy from bankruptcy. They're not wrong. A property with a GRM of 8 might look gorgeous until you realize the heating system is from 1975 and the roof leaks like a congressional budget. But here's where the narrative gets interesting. The GRM was never meant to be your final answer. It's the first date, not the marriage proposal. A quick filter to separate properties worth investigating from those you should ghost immediately. Think of it as Tinder for real estate. Swipe left on the obvious disasters, swipe right on the possibilities, then actually do your due diligence before committing your life savings. The investors who get burned aren't the ones using GRM for initial screening. They're the ones who stop there. Now let's talk about what changed. 20 years ago, markets moved slower, information was scarcer, and a quick back-of-napkin calculation actually gave you an edge because most people weren't doing any math at all. Today, you've got every rookie investor armed with podcasts, YouTube tutorials, and calculator apps that'll spit out IRR, cash-on-cash return, and debt service coverage ratio before their morning coffee gets cold. The optimism around GRM has definitely faded. You don't see it headlining investment courses or featured in those glossy real estate guru Instagram posts. Instead, it's been relegated to antiquated metrics lists, dismissed as too crude for our data-rich, hyper-analyzed modern market. But momentum hasn't entirely stalled. Walk into any experienced investor meetup, and you'll find plenty of old-school operators still using GRM as their first filter, precisely because it cuts through the noise. There's a psychological element here that's fascinating. When conviction wavers, when markets get frothy or crash, investors crave either maximum simplicity or maximum complexity. The newbies download 17 apps and subscribe to 4 data services, drowning in information paralysis. The veterans, they often circle back to basics, using tools like GRM to maintain discipline when emotion runs high. Let's layer in some historical context, because real estate markets are cyclical beasts. During the 2008 crash, properties with low GRMs, say 5 to 7, were often steals because prices had cratered while rents remained relatively stable. Fast forward to 2021's frenzy, and GRMs in hot markets ballooned to 15, 18, even 20 in some coastal cities. Numbers that made zero mathematical sense, but reflected pure speculation. Each cycle feels unique while you're living through it, yet the patterns repeat with remarkable consistency. Here's my own humility check. I once ignored a property because its GRM of 12 seemed high, chasing instead after a better deal with a GRM of 8 that turned out to have foundation issues costing $40,000 to fix. The lesson? No single metric tells the whole story, but dismissing useful tools entirely is just arrogance dressed as sophistication. So how does GRM fit into the broader framework of investment analysis? It's the reconnaissance drone, not the entire military operation. You use it to identify targets worth closer inspection, then deploy your full analytical arsenal cash flow projections, comparable sales, inspection reports, neighborhood trends. Community wisdom here, is surprisingly consistent. Experienced investors recommend GRMs between 8 and 12 for most residential rental markets, with adjustments for location and property type. Anything below 6 might signal distress or hidden problems. Anything above 15 should trigger serious skepticism about whether the numbers actually work. Let's tackle the biggest misconception head on, that using GRM means you're lazy or unsophisticated. That's complete nonsense. Efficiency isn't laziness, it's intelligence. When you're evaluating 20 properties in a weekend, running full financial models on each one is absurd. GRM lets you eliminate 15 obvious misfits in 30 minutes, saving your energy for deep analysis of the 5 genuine contenders. What are the practical, actionable lessons here? First, use GRM as a screening tool, not a decision-making tool. Second, understand your market's typical GRM range. What works in Memphis won't match Manhattan. Third, remember that lower isn't always better if operating expenses are astronomical, and higher isn't always worse if the property's in an appreciating market with low expenses. Context is everything. The number is just a starting point. The philosophy underlying smart real estate investment hasn't changed in a century. Discipline beats conviction, process beats emotion, and consistency beats timing. Whether using GRM or some fancy algorithm, the fundamentals remain: buy properties where the numbers work, don't overpay for hope, and never skip due diligence because you're afraid of missing out. Position sizing matters more than being right about any single deal. If you're putting 20% down on a property with a reasonable GRM and solid fundamentals, you can survive being wrong because your downside is limited and your learning curve is steep. Here's my comfort with uncertainty. I genuinely don't know if GRM will still be relevant in 20 years, and I'm completely fine with that. What matters isn't defending the specific metric, but maintaining the discipline to use whatever tools keep you rational, prevent emotional decisions, and force you to actually run the numbers before signing contracts. The real estate game rewards preparation, patience, and the humility to admit that sometimes the simplest tools, precisely because they force clarity, are more valuable than the sophisticated ones that let you lie to yourself with complex formulas. Whether GRM is dead or alive misses the point entirely. The question is whether it helps you make better decisions. And here's the beautiful truth about real estate investing right now. Despite all the noise, all the volatility, all the headlines screaming about bubbles or crashes, real estate remains one of the most reliable wealth-building tools available to ordinary people. The fundamentals, buying below market, generating positive cash flow, benefiting from appreciation and tax advantages, haven't changed. Yes, markets fluctuate, and yes, some years are better than others for acquisitions. But the long-term trajectory for well-selected investment properties continues pointing upward, especially as housing demand outpaces supply in most markets, and inflation erodes the real cost of fixed-rate mortgages. What matters most is taking action, educated action, disciplined action, but action nonetheless. Too many aspiring investors spend years analyzing, waiting for the perfect moment, consuming endless content without ever actually buying their first property.